Hi, everyone. My name is Johnny Wu, the host of the show Real Estate Hotline podcast. So today we have a mortgage broker, and he is one of the award-winning people that I know, and he's one of the best mortgage people I know, and it is Patrick Soy. He's the founder of MVP Mortgage Solution, and to chat with us today, he is a multi-award winner, and just to name a few, he has the best BDM of the year 2021, Mortgage Awards of Excellence, and he has consecutively won Top Sales Performer in 2020 and 2021. Thank you for joining us today, Patrick.
Thank you for having me, Johnny. I appreciate being a guest on your show today. I'm looking forward to our chat.
Well, there's a lot to chat about mortgages just because of the recent interest rate hike. So I'm just going to dive right in. So basically, June 1st, that was another 50 points. How has that changed in your industry?
Yeah, that's a great question. I think when we're looking at the industry, let's kind of how has that impacted the industry? I would say from a borrower standpoint, for any existing homeowners or anybody that has a variable term mortgage or an adjustable rate mortgage, which we can kind of talk about the differences, they may have been impacted based on either the amount of interest that's being charged or their payments could have been fluctuated or increased because of the Bank of Canada's overnight rates. So that was an increase of about 50 basis points. If you're in a variable term mortgage or you have a line of credit or a student line of credit or home equity line of credit, you can those payments are usually fixed, but the amount of interest will change that's being charged. That just means you pay less principal. Now, from a mortgage standpoint, at the end of that term, when it comes up for renewal, that means you pay less in the principal, so you're renewing at a much higher amount. Now, if you're an adjustable rate mortgage product, the prime rate that's set by the financial institutions, that's determined by the overnight rate, your payments will increase. And usually the increase happens on the next scheduled payment date. However, with financial institutions, they start posting payments to be pulled at least 3 to 5 business days. So if they're coming up within that period of time, you're probably going to notice that change right off the bat. It'll be on the next scheduled payment date. Now, how has that impacted also borrowers? If for 0.5% increase, that's approximately about $27 of an increase that they're looking at per every 100,000. So if we're using the example of a client who has a $500,000 mortgage, and we're calculating based on that, that's about $135 of an increase in either interest being charged or your payments increasing based on the adjustable or variable. So it really depends. If you're a borrower and you're listening to this call and you're not sure which product you're in, definitely reach out to either your financial institution, your bank, or your mortgage broker, and they'll be able to advise you. Usually, the banks offer variable term mortgages, and then the non banks or credit unions usually offer adjustable rate mortgages. So that's just something just to take note of. How has this changed the industry? Johnny, you and I were speaking earlier. I
Mhm.
think when we look at this, it's that the market is starting to slow a little bit. I've had many conversations with realtors, and some are seeing a drop depending on the market. I think when we look at, Toronto GTA, are we going to see a huge impact in, prices dropping? I don't believe so. I think, 10, 15% is not too much, but it could lead that way, right? I think the concerns that we see in the industry is, what's going to happen? Do sellers want to sell right now? And do buyers want to buy right now, knowing that rates are on the rise? And why are interest rates on the rise, right? Because obviously of inflation, you got the invasion of Ukraine, you got consumer goods, oil and gas. So the only way to get inflation back to 2% is by increasing interest rates. That's the unfortunate side of things. But we also have to remember that last 2 years where the pandemic was happening, that was unprecedented. I don't think anybody expected rates to be as low as they were, where they were like 149, and on a variable or adjustable, they were like less than 0%. So you're
Exactly.
already tapping into
Yeah.
the negative, right? So these are just times where everybody just needs time for change. It usually takes about 6 months for us to kind of adapt to everything. In my personal opinion or experience, what I've seen, I think even for sellers, if you're looking to sell and you're looking to buy, Is this the right time to sell, but is this also the right time to buy? Because your purchasing power could be less while rates increase because your qualifications become tougher. In Canada, as you're aware, we have the stress test. So it's either the greater of the minimum qualifying rate, which is previously known as the benchmark rate, which today is sitting at 5.25%, or you're qualifying on your contract rate plus 2%. If we're looking where variables are going or fixed rates, that's well above the 5.25. So that's something I would say that's how the industry has been impacted so far. I think this is a time for borrowers to really reach out to their banks or their mortgage brokers, and kind of discuss their financial situations, or do they have cash flow available with these rate hikes that may be happening, because there's much more rate hikes that may be coming our way. There are projections with one coming up in about the next month of about 0.75%, and we can talk more about that as we go along. But yeah, I would say that's kind of what's been happening with the change in the industry so far.
So basically, just to kind of summarize here, so with every $100,000, because of the 50 points increase, we're looking at like about $27 for every 100,000
Mhm.
because of that, right? And then I think another note that you're saying is that obviously things are cooling down, borrowing power is obviously getting less because of this increase, and we are just seeing a slowdown in the market. And so kind of segment into our next question is, what are some of the most common conversation you have been having because of this?
Yeah, I would say the most common conversation that I have, regardless of where the market is it the right time to buy, right? I think if any borrower speaks to any realtor or any mortgage professional, everybody's going to say it's better to be in the market than not be in the market, especially if your future goal is to buy a place or to invest, right? Because you never know what's going to happen in the future. If credit qualifications start to tighten up, which they already have based on the B20 and the stress test, if that continues to tighten up even more, could it be more challenging for you or the future, the next generation, to even qualify further? Nothing is forever, right? Real estate is always up and down. Mortgage rates are always up and down. I think it's just being able to be patient with the market. I've in the 17 years I've been in this industry, conversations is that the last time I saw rates around 5%, which we start noticing for a 5-year fix, that somebody who's buying above $1 million, they're above 5%. The last time was about 14 years ago. That was the last time I saw rates that high, right? So I would say don't always get comfortable, but plan accordingly. If you have the funds and you can qualify, then do so. If you have savings or you're able to get gifted funds or RSPs, TFSAs, and all that, there is a lot of generational wealth out there, right? And immigration continues to come into place as well. They're expected about 400,000 people coming into Canada for the next following years. So there will be a high demand. But where the market is obviously shifting as well, I think it really, really depends on everybody's finances and whether you have the ability to qualify and actually you want to get into the market. But yeah, I would say that that's the most common thing I have. I think the other thing is with buyers, especially if you're a first time home buyer and you're just stepping into the game, or into the market, is to know that it's more than just interest rates. It's more than just down payment. It's about making sure that you're comfortable making that mortgage payment. Do you have the cash flow and do you have the affordability to do so? There's other costs that come with it. The carrying costs of, if you're buying a condo or townhouse, you have maintenance and condo fees. In Ontario, land transfer tax. Surprisingly enough, not a lot of borrowers know that there's land transfer tax that they have to pay,
Absolutely. They
and they
ask me
either
that all
find
the
out
time.
exactly, and then you kind of have to explain it. You might get a rebate if you're a first-time home buyer, you might not. But in Toronto, you pay provincial and municipal, and then outside of it, you don't.
It
So
hurts
I
the
think
wallets.
yeah. So I think that is something, the main conversations I continuously have, it's laying out the numbers and saying, do you have the affordability to do so? Have you factored in all of these costs and planning for that future for the client. They may not qualify today, and I have a lot of those clients that, you know what, they may not qualify for the purchase price that they're looking for, but doesn't mean that 6 months from now they can get there, right? If they are short down payment, is there ways of getting down payment for them, right? I think that's one thing. Credit, if they don't meet the credit qualifications, could they improve their credit? Are they far off? But there's so many options there outside. Like there's A lenders, there's the alternative A's, the banks, you have the credit unions, you have privates, you have B lenders. So there are options out there. But obviously, when you're stepping away from your traditional banks or your A lenders, everything kind of comes with a cost or a premium of a rate, right? So that would just say there's that. And I would say if you are comfortable with making the mortgage payment, then go based off that amount. But if you're focused just solely on the rate, then that's always going to be the most thing that's always going to scare you, right? I go based on payment. Is this a comfortable payment within your budget that you can afford while factoring all the additional costs?
So we just have a person that raised their hand. Taha, I'm just going to say we're going to leave questions at the end. We just have a few more questions to go by, and then we will be answering questions at the end, okay? So basically, I think I'm surprised that most of the common questions you get is it the right time to buy? It sounds like it's a question that a realtor should be getting, but sometimes I totally understand. Sometimes they talk to the mortgage person first, not the realtor first. So totally understand why you get that question, but it's also in a way that that question should be directed to a real estate professional. Obviously, you know the market yourself, but I think there's a lot of factors because it could be a life stage thing. It's not just a mortgage interest rate thing that's like, oh, I'm gonna buy now. It's multiple factors, and it could be a job, it could be a family, it could be downsizing, it could be multiple factors here.
Mm-hmm.
So I get this question asked a lot because of the interest rate hikes that's coming up, and that has happened. So people are in a variable rate about a year ago. Now they're like, oh no, should I change it to fixed? And can you do that? Can you just like go from variable rate and be like, oh, now I want to change to a fixed? If you can, how do you typically go about that?
Yeah. So what you're asking there is the ability to take a variable and turn it into a fixed. So with mortgage lenders, what we call that is a conversion option. That's converting your variable term rate into whatever the current fixed rates are at that time in the market, right? Obviously, right now, fixed rates have continued to be on the rise. Is it the best time to convert? In my personal opinion, as a mortgage broker, no. Kind of stick it out with a variable, especially if it's still much lower than fixed rates and you're still getting a discount towards that prime rate. But conversions, yes, every lender is different. There are some lenders where their variable term contingencies for the conversion is that they can convert into a fixed rate product that is equal to or greater than what they have left remaining on that variable. So let's say you went in a 5-year variable and you have 3 years left remaining, you can go into a 3-year fix or higher. However, there are also financial institutions that have products, depending on your product as well, where you may only have an option to convert into a 5-year fix. So that's another thing, because some products are only offered in 5-year term basis. If it's a specialty type of product, which means you can only convert into a 5-year fix. So it all really varies. Their conversions usually don't come with a cost. It's simply as reaching out to your mortgage broker or your bank or your financial institution, asking them what are their current conversion rates if they wanted to go from variable to fixed. They'll quote them to you, and then you kind of make that decision. They send you documentations for the conversion, and you just send it back, and it's usually effective on the agreed next scheduled payment date.
I see. Okay, so it's just a conversion rate. It just depends, obviously, whatever you have agreed to before, and just to see if there's any conversion costs. Usually there aren't any, but it could be depending on what you sign up for. And I think some terms for mortgages are that you can't change. There are some there could be some other terms and conditions that it's like, sorry, you just can't do anything. So just reach out to your mortgage person and specialist, and they'll be able to help you with that. And it's called the conversion. All right. So thank you for educating me on this. The next interest rate announcement is on July 13. I thought it was September, but it's actually July 13. And then there's another one September 7. and there's another one happening October 26th.
Mhm.
So we got three pretty much kind of neck to neck. And then basically the bank, this is from the Bank of Canada website. Anyone can find it. It's not a secret. Any predictions on these announcements that might be, and how do you think it'll affect real estate slash the mortgage
Yeah.
industry?
That's a great question. I think when you ask anybody, everybody wants to project and kind of have that, magic 8 ball of telling what the future is going to hold, regardless
Absolutely.
of what any economist says or everybody is just projecting. Nothing is actual factual until it actually happens, right? We can't predict what the Bank of Canada is going to do because there's so many factors. However, yes, with the next scheduled one on July 13th, there are projections that there may be a 0.75 increase
0.75.
on the
Wow.
overnight rate. So that could be pushing the target rate to 2.25%.
Yeah.
So if this is to happen, and again, for those in a variable or adjustable rate mortgage, that means your payments or the amount of interest would increase. And if I use that same scenario on a $500,000 mortgage, that's about another $39 per every 100,000. That's potentially increasing your payments or the amount of interest to about $195 a month. So that's something
Wow.
just to hear. And the reasons, obviously, with a recent there was a recent interview that I was watching with our finance minister, and he was asked, "Is the Bank of Canada and the government willing to force a recession a recession to get inflation where it needs to get?" Obviously, the response was, "We'll do what we need to do," right? Um, I'm hoping that it doesn't get there, right? There's just many factors that come into place with this. You have, like I mentioned, the invasion with Ukraine, cost of consumer goods, oil and gas is increasing. Pandemic. We're still living in a pandemic. It has not yet ended, you know? So I think people need to factor all of that in. And it's a global impact. This is not just a Canadian market impact. So I think it's just to be aware about that. We need to stabilize the market. And it's tough to say. I think to kind of get it back to 2%, we m- we I think there might be a couple more hikes. Now, in my opinion, I believe that if the invasion of Ukraine, if that complete stops, then we'll probably get to see a little bit of that reduction. So it just really depends. And I think this is just really, even with the other dates coming up, it's hard to say. I don't like to always project that far out. I'm somebody, when it comes to the market, likes to see where things are every 3 months to 6 months to get a better idea. And I think that just comes with over the 17 years of kind of being in this industry and also living through a credit crisis that was back in 2008 and seeing where rates were and what was going on between Canada and the US economy.
Gosh, so July 13, we're expecting a 0.75 75 points increase basically. And then so I guess it's just going to keep increasing. I think there were articles that saying 2%, 2.5 is well within the sites. And that's going to really cause a big slowdown in the real estate market, as we're seeing here throughout GTA. There are certain pockets that's hit harder. And I think you talked about the war in Ukraine many times. And that I think that's a key big factor here. And there are obviously inflation, there are obviously a lot of logistical um, costs that's involved. Like if you go to IKEA, you can not find anything you like because there's a shipment issue. It's a global thing, and yes, a pandemic. I think a lot of people do forget that at times.
Mhm.
And I think you're just saying that strap on, and you're going to see more interest rate hikes, and
Yeah.
obviously things are probably not going to turn out so well. Yeah.
Look, I hope not, but it could happen. Even the other day, they were starting to say that companies nowadays are starting to put less quantity in packages of like food or like accounts. They're reducing the size of them, and usually when that happens, the chances of it getting back to normal, back to where it was, could be very slim. So if you start noticing some of that, just to keep the cost of goods somewhat down, so there's no increase in it. So I was watching that on the news the other day in the US, and they were kind of talking about that. But it's we all just have to remember that this is everything is short term, nothing is forever.
And segmenting into this, appraisals and mortgages, they kind of work hand in hand. So this happens a lot recently, especially for people who bought in March or April and now they're closing. Um, so I'm very interested about this question because appraisal comes in kind of late in the game. Like you buy real estate, the appraisal can happen like a month before closing, 2 weeks before closing. And then all of a sudden the appraiser is like, hey, sorry, the place you bought or it's not at that value. And now they're short. So why is this process like that? Can you
Yeah.
give me shut some light there?
Yeah. So not all mortgages, when you're applying for them, require an appraisal. That's the first thing. If you're a high ratio borrower, the chances of getting appraisal is very slim because you're putting less than 20% down, unless the insurer wants it. It's usually when you tap into the conventional space where it may be required, depending on the lender or bank that you're going with. Now, when it comes to appraisals, it is the responsibility of the mortgage broker or the mortgage rep that you're dealing with to either order that appraisal and making sure, and for me, it's ordering as soon as you can and getting that report as soon as you can, especially if you know that the volatility of the market and prices may be reducing. Why are you waiting closer to closing to order that appraisal and to get that done? Now, where that can also be, this is more so for resale properties, I would say. For new construction, those are a bit tougher, right? Because sometimes they may not let you in until a week before, 4 days before, and that appraisal report. So that's out of our control. But usually, if the appraisal comes in below what your purchase price is, that can cause a concern. That means that you, as a borrower, have to come up with a difference between the purchase price and what the appraisal is, because a lender won't move forward with that. The other thing is, if the property is less than $1 million, we can try seeing if we can get fitted into the insurable space. But then that means you're paying insurance premium. If you have a 30-year AM, you might have to qualify on 25-year AM. So it really depends. I've seen in situations where the value what came in $200,000 less, right? The clients ended up having to get gifted funds from their parents to come up with that difference, because the seller would not let them go, because the seller was selling their property so that they could buy a new place. If that seller wasn't probably, buying a new place, I think they would have been a bit more lenient with that. But it can cause legal complications. So I think it's very, very important making sure that, one, you're working with a great realtor like Johnny who knows the market and understands. He's not just there just to overinflate the values,
Thank you.
and then
Thank you.
all of a sudden you get something less than, because that can cause huge concerns. Even with a mortgage broker, we can sometimes do our own analysis and we can pull certain stats on the area, and we'll be giving you honest, transparent advice and saying, you know what, this could be a concern. Be prepared that you may need some additional cash flow if that property value comes in less. But your question is, who is responsible to making sure that appraisal comes into place? It is the mortgage broker, but there's no control when it comes to new construction. But that's something, especially if there is a decline in prices, that borrowers do need to be made aware that they will need to come out with that shortfall.
So like
Now,
this is really interesting because I didn't know the mortgage person can actually order the appraisal person to go. I thought it's like a more of a lender thing that they do it kind of thing.
yeah,
So that's actually interesting to know.
yeah. So some lenders will order it themselves, and then some of them will say the broker has to order it. The broker orders that the appraiser then contacts the client for scheduling the appointment when they're available. And then when the report is done, the appraiser is directed to send the report to the lender. And also the broker gets a copy of it as well. But yeah, most of the time, it's usually most lenders allow the broker to go ahead and order that appraisal.
So you can order it like let's say the closing 60 days from now, you can order it like maybe if 30 days in, or you can
Yeah. So appraisals are valid usually with most lenders anywhere from 60 to 90 days.
okay. Good
Yeah.
to know
Yeah.
because I tend to get heart attacks when an appraisal
Right.
literally happens 2 weeks, 1 week, or 3 days before
Yeah.
closing, and then people start to freak out, especially at this market.
Yeah.
People were not thinking about this at all. In Q1 when the price kept going up, no one really cared about this. Obviously, a lot more people are caring about it.
Mm-hmm.
Just a side note, I did get a question today from a realtor that said, "Hey, I want to put in a clause that's saying that if the appraisal comes in lower, my buyer can pay a lower price." And I was like, "There is no way any seller is going to agree to that, right?
Mm-hmm.
And what if the price went the opposite way? Is your buyer willing to pay a higher price, right?" So I'm just getting a lot more questions and a lot more legal clauses that want to kind of like combat this potential lower price or price
Yeah.
drop kind of scenarios.
Exactly. I think appraisals, like I mentioned, are not always required, even if it's in the conventional space where it's below 80%. There are some lenders who have an automatic valuation model system where they can determine the value, and if it supports it, then your client's fine with no appraisal. And that there are selective lenders that offer that. I think some of the smaller lenders out there, they usually want a full appraisal report that's being completed, but the client will know is that when they get their approval, the commitment will indicate that it's conditional to getting a full appraisal, and if not, then they're fine. Usually, AVMs are good for up to anywhere from 70% LTV. Some lenders may do up to 80% LTV on it, but they have thresholds on where the value is. So if the purchase price is say less than 1.5, some might be able to push it through that AVM system. But if it's above it, and where we are in Toronto GTA, we're seeing a lot of detached homes well above that. That's where the appraisals are usually required. Yeah.
I I guess my my next question is
Mhm.
actually about mortgage instructions. And I get this quite a bit. So when a buyer buys, makes a purchase, they secure their mortgage because there's a commitment letter that's signed and everything else. And then they select a lawyer. Okay. That's a usual process. Why is the mortgage instruction provided to a lawyer like always 90% of the time,
Mhm.
90% of the time, in my experience, like so last minute? It's
Yeah,
just so last minute. Why is that? Tell me why.
that's a good question. That's a question that sometimes even mortgage brokers ask the lender, why do you guys send it either last minute? So it all really varies. I think there are the way to get the instructions sent quicker is for a borrower, a client to provide all their documents up front. Because some lenders, I could name some, let's say MCAP or RFG or RFA, they will instruct the file as soon as they get a sign back. So what I mean a sign back, the commitment letter, all they need you is to sign back that commitment letter. We send it back to the lender, and they'll instruct a lawyer. However, there are some banks and lenders who say, we will not instruct until you have met all your client conditions and broker conditions. So if you have an appraisal outstanding, that could hold back the instructions. If you have, if you're pending a verbal verification with the employer, that can hold the instructions. So you're meeting the down payment and all that stuff to be prepared, especially for first time home buyers. Collect all your income documents up front, your down payment up front. They're going to want to see the 90 days history. It just makes the process more easier to flow. But there are some lenders as well who will say, we're not going to instruct it to at least until 2 weeks before closing. Now, we also have to remember that sometimes the file is also instructed, but a lawyer may not contact the client until 2 to 3 weeks to closing. They'll call them, they'll say, hey, here's an introduction. These are my fees. Please go to my website, complete an intake form, upload your ID, so on and so on. And then you may not even hear from them until a week or 2 weeks before first signing, right? I remember even buying my first place, I went through that and I was like, when is the lawyer going to contact me? Instead, I was proactive and I kept calling the lawyer and saying, hey, we are now, 2 weeks to closing. When were you actually going to call me? So then I was able to have it. So I would always say, making sure that if you're dealing with a mortgage broker or a bank, asking them when do instructions get sent because every lender is very different, right? Your broker
Mhm.
should know if you're working because they should know their lenders and their process. So I think it just really varies between lender to lender.
So here's a more technical question here. So basically, um, a buyer buys the property, right? They obviously had a mortgage commitment letter from you, from someone, mortgage specialist prior, right? Everything looks great. Lawyers, intake form, everything's done. And they sold their home, right? They sold their home, and then they're waiting for the mortgage from that sale, like the funding. Um, so there's actually two parts here. So basically, once the mortgage instruction is received by the lawyer, um, there's a back end. The lender, there's a back end part that they had to kind of flip a switch, saying from pending to here you go, here's the money. So let's just say a bank, right? The mortgage specialist does their best, all the paperwork's aligned. The day of closing, right? Day of closing, there's a wild card, I feel, because the
Hmm.
back end person who I don't know the technical term of
Yeah.
this person's job, but there's a back end person here that had to like send a check or give the funds to the bank, and the bank then gives it to the lawyer.
Yeah.
So can you just shed some light?
Yeah.
Because I had a problem with
Yeah.
that.
Well, I can definitely give you the answer to that. I think for me, I actually worked on the lending side prior to, so I know how the whole process internally with a lender, with some lenders work. But I think what you're asking is when do the funds get released? It's called an RFF, and that's dependent on it stands for a request for funds. So usually, once the lawyer has already completed the signing with the client, it is the responsibility of the lawyer. They have to meet their conditions, which means pulling title search, getting the clients to sign. And then there's technically supposed to send the lender an RFF request for funds at least 3 business days to closing. Sometimes that doesn't happen. Sometimes there could be delays, with signing or little hiccups here and there, right? But that's where sometimes that last minute is like we don't have the funds. Is because either the lawyer didn't meet all their conditions, there was outstanding, or there was errors on the documents that they had the clients complete, and so on. So it wasn't acceptable to the lender, because when the lender sends the instructions to the lawyer, they're saying you need to meet all these conditions to us and make sure that you send a request for funds at least 3 business days to closing. Now there are things that are being done within the last hour, and those require like a rush wire transfers, but it all depends on the bank, because if those funds are usually not there, I would say by noon in your local area times, that's where it could cause issues, unless it's like an emergency where they might have to run to, somebody at the lender may have to run to the bank
Yes.
and get those funds deposited. I've seen it happen, but I think that is, yeah, that's more of the responsibility of the lawyer to making sure they satisfy their conditions and send that request to the lender on
This
time.
is why I advise my clients to never close, or ideally don't close on Fridays, because it just very recently happened to me where one of my clients were dealing with CIBC, and
Hmm.
then they cut the funds, the check at 4:55 to a local branch. And then it's like, it's 4:55. I don't think we're going to close today.
Yeah.
And then there was a very unfortunate situation, obviously. But it does happen. And
Mhm.
I think it's good to know these terms are RFF. So then you can be like, check on an RFF and
Mhm.
making sure that the signing happens 3 days. I didn't know about the 3 day rule. Usually the lawyer signing thing happens like literally the week of closing. Like
Yeah.
it's so close. So definitely good to know. I don't
Yeah.
think lawyers usually let people the buyers sign or the sellers sign documents very
Mhm.
early on anyway. So usually a week and a half is kind of nice, but
Yeah.
usually it's like literally the week of closing.
Yeah, and I think even a good thing that came out of the pandemic, there's also virtual signing that can be done nowadays, right? You don't necessarily have to go into the lawyer's office to sign. So that's a good option. The request for funds, I think with any lawyer, it's making sure that if they send it at least 3 days before, and say they're not fully fulfilled, the lender can still start the process of transferring the funds to have it held in trust. So once it comes to the closing, it's simple as saying, "Are we good to go? Yes, go ahead and release the funds. You have them." But that's the problem, is that sometimes lawyers don't actually provide that request for funds on time, and they send it on the day of, and then you're doing everything in that same day, and that's where it causes delays.
So now I'm going to move on to questions that the audience is going to ask. So I'm going to So I actually have Alice. She's not here right now, but Alice is asking, what is the difference in a mortgage broker, agent, and specialist can do?
The difference is, so why is a mortgage broker? So a mortgage broker is a licensed professional in your certain jurisdiction of a province. So in Ontario, like myself, I'm licensed in Ontario. I am an entrepreneur. I'm business for self. I work for myself, but I work with multiple lenders versus a mortgage specialist that you're dealing with the banks. They only know the bank. They only sell the bank's products. They don't have access to other options outside of their bank. So if you don't qualify with that bank, then you're stuck and then you're running to another institution. A mortgage broker has the ability to work with you and go through all your finances. They will pull your credit one time and they can shop your application around
Mhm.
to some of the banks, to some of the non-traditional banks, credit unions, B lenders, all of that. We're pretty much your consultant and we're there. Mortgage brokers are 100% commission. So we're not the 9 to 5ers, right? So we kind of invest more into you. We work for you, the borrower, as opposed to us working for the lender. Some people ask, how do mortgage brokers get paid? We get paid usually through a referral through the lender. For like a good AAA deal, now there are some deals, if it's a B deal, are more complicated where some fees can be applicable. So it just all really varies. But I would say that's one of the differences. You're limiting your options if you're just comfortable going to the bank. It's better to consult with a mortgage broker, and they can sometimes place you with some of the banks if that's the better option, or if it's a non-bank, right? Because let's say, for example, fixed rates at a bank, on average, and then the fixed rates at a bank. Let's say, for example, on average, most people break their mortgage about usually around 3 to 4 years in, either to consolidate debt, home renovations, maybe they're looking to downsize, maybe looking to upsize. The penalty can be much higher at a bank based on their interest rate differential if you're in a fixed term product versus a non-bank, which could cost you thousands of $1,000 less. Now, there are certain products that are restricted as well, depending on your bank. If you're chasing the interest rates, sometimes these very low interest rates that you may see are there no frill mortgages, which means that you don't have the ability to refinance early. You don't have the ability to transfer your mortgage to another institution before the term is up. The only way for you to break that mortgage is by selling your home, right? So if you are somebody who's a first-time home buyer and you're planning to, uh, say, grow a family, right? You might want to buy a bigger place. And maybe you want to do some renovations to your existing home. That just because you got a low interest rate, that can restrict you from doing that. So it's always important to speak to a mortgage broker and focus on what is the right product for you and the right rate based on that product that is most suitable for you. It's not just about the interest rate, because you don't want to be stuck into something and then be like, oh, I had no idea, right? Sometimes you got to read those fine prints, and it's our job as mortgage brokers to making sure that we educate you on the lender's products, and programs, and the conditions and what you can and cannot do, as well as your lawyer will go through that with you as well. So
Mhm. Absolutely. And then another question she had was, um, does pre-approval guarantee lending as long as conditions are met?
yeah, so times are changing. With the pandemic, many lenders kind of stepped away from doing pre-approvals. There are still some that still do it. There's a difference between a pre-approval, which normally you consider them being qualified, but it doesn't guarantee you an actual mortgage, because until you have found an actual property, you still have to qualify, making sure that that property meets the lender's requirements,
Mhm.
right? If it's a tear down, it's not something they want, and in an odd location in a small town, the lender might be saying, "We don't lend there, sorry," right? So you might be saying you qualify maybe 50% of the way. Once you find that property, then you place an offer down. Then we seek a firm approval that is conditional to be meeting the income, down payment, and all that information. Now, there's also rate holds. Rate holds approvals are simply just a rate hold. They haven't reviewed your income, they haven't reviewed your credit, they haven't reviewed any of that stuff. They just simply said, here's a rate hold. We'll guarantee that for you. But when the deal goes live and you have a firm property, then we'll qualify you at that time. So yeah, I always say, try to it's the first step is to get pre-qualify so that you can determine what you're pre-approved for.
Mhm.
And then once you're pre-approved, that's the time for you to go hunting with your realtor, looking for a place. I think there's many different programs. Even working with a realtor, you might find this perfect home, but maybe you don't like the kitchen. There are programs even out there that called a purchase plus improvements. It's springtime where people might want to do some minor renovations, right? So that's just things that you can also offer. Yeah.
So now I'm going to open the floor to our live audience for the very first time on a Real Estate Hotline podcast show. So I'm just going to ask Mansoor to unmute himself or to share his screen. So please go ahead.
Hey, thank you, Johnny, and thank you, Patrick, for this very useful information. I have three questions, but I'll take turn if there are other questions from anyone else. My first is this RFF process and also the mortgage final document signing sequence. So which comes first? Like the lawyer gets the signing and sends the paper for the request for fund, or it's first the final mortgage signing that happens when the buyer has to get the thing signed.
Yeah,
So
well, that's a good question. We'll start with that question first. So I think the process is initially you'll sign some documents with your mortgage broker, which is your mortgage approval commitment. We send that back to the lender. The lender then will send instructions to the lawyer. The lawyer will then meet with you to have all the registration for title, and they'll also have a copy of the commitment and just to kind of go over the final conditions, products and clauses, and your cost of borrowing and all of that. And then from there, once you finish the signing, they send all that stuff back to the lender because the lender is the one who's requesting them to complete the legal side. They're representing you and also the lender. And then the RFF is what they should be sending back as well 3 days to closing. So I hope that answers your question.
you did, and it created a little concern for me also because one of the closing is on Wednesday, and I haven't heard anything happen yet.
I would call your lawyer.
Okay.
Have you met all your conditions?
Yeah.
Yeah, so I would probably call your lawyer, or if you're with your bank or with a mortgage broker, reach out to them and saying that you have yet to hear back from your lawyer. Have you spoken to your lawyer at all?
Frankly, not, because I was speaking to my client and he said everything is going well. So I did not. I worked with that lawyer before, so I did not follow up. I thought, okay, everything is going well, so I won't follow up. But I still have for 2 days, so we'll definitely connect them now.
Yeah, because the other thing is if we don't, we need to also find out, one, did the lawyer even get the instructions?
Yeah. Did they get it? I was going to ask, did they get the mortgage instructions yet? Mansoor? No, I think he's with his kids.
Yeah,
but
he might be a little bit occupied.
But yes, if I was him, I would be kind of scared too. If closing's Wednesday, it's Saturday now. I hope that the lawyer already have talked to the client on Monday, or will talk to the client on Monday, and then hopefully mortgage instructions are coming. Sometimes mortgage instruction comes in really last minute, and I guess the mortgage instruction kind of comes first, right? And then the RFF then goes.
Yeah.
So
it's instructions first because the lender has to send the instructions, and then the lawyer does their thing, and then they send the RFS usually 3 days before closing, right?
Yeah.
So, I would be, if I were Mansoor, yeah, I would be a bit concerned as to why nobody has signed yet, especially if you're closing in 3 days.
So Mansoor just joined us back, just because he kind of went out and came back in. So I'm just going to ask him to unmute himself. He has more questions.
Hey, Mansoor.
Thank you. Sorry, and I guess Johnny guessed is right. My kids, they want me to take them out, and I said yes. The second question is regarding the pre-approval for the pre-construction, and especially from the point of view of that it's a non-resident Canadian who is outside the country, how easy is for them to get the pre-approval from the brokerage like yours, and whether that is accepted by the builders or it depends on the builders?
Well, I think usually Johnny might be able to answer this question. Usually with builders, they usually have a team of institutions. I think most of them are usually RBC and CIBC from what I've seen, that they kind of say, if you're going to purchase from us, you need to get a pre-approval from these two lending institutions and partnering up. I would say for non-residents, pre-approval, so just to put it out there, usually pre-approvals can come have some certain restrictions, and it usually has to be an owner occupy your primary residence to obtain a pre-approval. Most lenders won't offer it on a second home or on a rental property, so those are things you got to factor in. For a non-resident, it can also be tough because they need to really look at your overall credit, how long you've been here, and pre-approvals are more for for individuals that kind of have that already in place where they can just view it. And I think for non-residents, I don't believe there, from what I know, I could be wrong, but I don't believe they offer pre-approvals for non-residents.
And just from the real estate perspective for pre-construction, some builders require mortgage commitment letter, some don't. So it depends on the builder, depends on the project. And then they typically like to see it from a lender. And sometimes they do partner up with a specific mortgage company or mortgage specialist / bank. Yes, and then because that's exclusive with the builder, they tend to be able to do maybe some more helpful things because they probably get some sort of kickback for helping people and all that stuff. So if there is a person on site, yes, you can definitely talk to them and see if they can help you out because they work exclusively with the builder. And because they are foreign, the builder is definitely going to be more, they're going to scrutinize your client a bit more because it's not just the down payment aspect that's going to increase. There's a lot more that they have to think about, and what the intent is. Is it a user, is it an end user, or is it like an investor? Like they have to know a lot more information. Yeah. I used to work for a pre-construction company, so been through that.
Thank you.
Any more questions?
No, I'm missing this one-on-one kind of an opportunity with Johnny, and you have created. So I guess pretty much the only one thing that why it takes so long till the last minute for the mortgage to get it signed off, because in my last deal, my client really has to go from pedal to post to get, okay, where is my mortgage? Where is my mortgage? And yes, we are working on it. It's taking time. Is there just the agent, whoever is involved, they are overwhelmed with the work, or it's the normal that it takes till last 3-4 days?
Yeah, that's a good question. I as a mortgage broker, for me, I personally believe it's our responsibility to making sure that the process is smooth, that we set proper expectations, and that we follow up, right? This is a client's or consumer's largest financial transaction that they'll probably ever make their entire life. So to not be attentive to that, or to not know whether instructions have been sent or when the sign is taking place, or following up with the lawyer, you can follow up the lawyer and saying, hey, did you get the instructions for my client? Perfect. And then, I've gone to the client and saying, make sure that you also follow up with your lawyer. Don't wait until 2 weeks before. If the instructions went out, and I will tell my client and say, hey, I have notification. The lawyer has sent, the lender has sent the instructions. Please follow up with your lawyer in a week's time, making sure that they got it. So that is the responsibility of really, in my opinion, it's the bank rep or the mortgage broker to making sure that those instructions were sent, because obviously they need to make sure that the mortgage gets closed on time, right?
Absolutely.
So,
And I think it depends on, I guess the question could be like, are there outside factors that, communication is key to prioritizing everything, but are there any outside factors to even the best mortgage broker it's outside their control?
Yeah, I think we don't know the full story, right? We don't know if was there any outstanding documents, whereas the file was a customer or broker complete, right? Because we call it broker conditions because the broker has to obtain this and complete this in order sometimes for the file to be instructed. It also depends on who is the lender, right? Is this lender a lender that will only instruct once the file is broker complete 100%? Or are they a lender that instructs once they get the sign back and then you can fulfill the other conditions by closing, right? So it really varies. I think there's more questions for you to ask your client and also ask the borrower to kind of find out. So yeah, it's hard to say, but that's just where I say, for any future clients that you may be dealing with, is or for, if even for myself, it's try to get the documents up front, right? You don't want these last minute things to happen because it just creates a not a good overall experience.
I think another point to add there is that as a realtor, what I like to do, I just tend to ask, hey, who's your mortgage person? Even if it's not someone I know, it's fine. And then I just kind of collect the lawyer information as we do. And I just send one email with like, hi, lawyer, mortgage people. This is one email. Just want to introduce myself because we all have to be on the same boat and on the same page to get the deal closed. So I kind of just send one email introducing myself and then just basically saying to everyone, hey, this is about to happen 1 week before, because usually realtors have to send an APS anyways and the complete documents to the lawyer. So and to the mortgage person sometimes if the client isn't aware. So basically I just kind of do that one email so everyone's on the same page from the get-go. However, depending on your clients, sometimes things can change. From a lender may not, everything was signed and everything was good, and then the A lender decided not to go with them. That has happened, and then suddenly the mortgage broker is scrambling to get a B lender in place, and so on. Or I have heard of stories where A lenders, although the commitment letter was everything was good and there's nothing wrong with that purchaser, they fell through, and then closing is like in 10 days. Like I wonder how that actually happened when a bank gets your commitment letter, everything looks great, and then they sign on the dotted paper. They're just waiting. The purchaser is just waiting to close, and then right before closing, the bank is like, "Oh, did we say we want to give you money? We lied." Whoops.
Yeah, so I can actually answer that question. From coming from the lending side, usually there is post auditing that's done. So even though the clients, you get the deal for a lender, they have an underwriter. The underwriter reviews the deals. They review the documentation for acceptance. Once that file has been, let's say, completed on their end and the instructions have been sent, sometimes lending institutions have a post audit team. So if they're reviewing the documents or they review anything, or they said, you know what, we're not comfortable with, let's say, the location of the property, we shouldn't have approved this. That's where sometimes those things could be declined. We also don't know what may have come out of a verbal verification for employment. Did we find out that the client is not guaranteed hours, right? But they told us they were guaranteed hours. Now maybe they don't qualify anymore. So there's all these little things that could occur, or sometimes somebody may have gotten laid off or changed jobs without telling the lender. That could be another thing. I've seen it happen many times where they go signing at the lawyer's office and then they have a different type of employment. And the lender's like, what are you talking about? Oh, the client switched jobs. Well, you didn't tell us that. So now you're scrambling last minute saying, can we even get an exception? Is, well, the fact that, and I think those are expectations where the mortgage person, whoever you're dealing with, is to have that conversation with the borrower and saying, one, don't apply for new credit. Don't rack up your credit. Don't switch your job during this time.
Don't buy a car.
Don't go and buy a new car, right? These things can impact, and sometimes some lenders can pull another credit check, right? They can do a soft pull credit check and they'll say, what is this? What happened here? And that's sometimes where things can collapse. Now, even going to, I think credit scores, I've seen that. If the clients don't close on time, say it's a new construction, but the closing keeps on getting pushed out, that rate has now expired. If that interest rate expires, the lender has to pull a new credit check. If the client's credit doesn't meet the requirements anymore, then that deal collapses. Then you got to find somebody else. So if it doesn't qualify with an A lender, now you got to place it with a B lender, right? If it doesn't qualify with B lender, then you're kind of scrambling saying, do I go the private route? So it all really depends. Yeah.
Oh, thank you. Thank you so much. Mansoor, did you have anything else?
Yeah, just last question. But before that, this switch of employment, I had to deal with it just end of the year. But luckily, I was able to secure a unique deal that the unit that we bought, we rented for the initial period and we delayed the closing by 3 months so that the switching of job should not have an impact on the mortgage approval. So maybe a separate story to share someday. But one last question. I'm myself in between the renewal of two mortgage for someone, and the rate which is variable is coming. Do we have any idea what is the best benchmark right now for the variable rate is in the market, like prime minus 1.05, prime minus 1.1? What is the
right now variables? It depends. Like if this, you said this is coming up for renewal.
That's correct. Yeah.
Yeah. So renewal rates can vary different lender to lender. What you might get for like a new purchase may not be the same on a renewal. Most lending institutions, they have a division of renewals team, and they usually will discuss. Sometimes they can be more discounted, sometimes they could be more premium. So it really depends on the client's situation and what type of mortgage they're in. But I would say from a new business standpoint for a purchase, if it was like a 5-year variable, we're looking anywhere from prime minus 20 to sometimes prime minus 50 or prime minus 40, 50 right now. That's very different than, where it was back a few months ago, where it was like prime minus 1, or prime minus 0.9. For high ratio business, rates are still pretty good. If you're able to have the ability to buy less than 1 million, variables are still good around that. But when it comes to over $1 million or the conventional space, do expect that rates are much higher than high ratio, right? That's always been kind of how things have been with the whole B20 changes that happened in 2016. When things that were over $1 million can no longer be securitized through the insurers. So that's I would say that's where the rates are for new business. But if you're coming out for renewal, I would suggest reaching out to either your mortgage broker, because they might have the ability to reach out to the lender on your behalf, and they can kind of negotiate and saying, hey, my client, I have a consent form on file. Can you let me know what the renewal rates are? But if it's the bank, they have their own renewals team. They won't talk to brokers directly most of the time for that. But you can always go to banks too. But banks usually, if you're coming up for renewal, most lenders will send you a notification anywhere between 90 days to 60 days to that renewal time. By law in Ontario, they have to send at least 30 days. So you'll get something in it, and that's your time to negotiate with them. So don't be afraid to ever negotiate with the renewal account manager or the renewals team that you're working with. You don't always have to just accept the rate that it is, especially if you have some leverage from one other institution that might say, I want your business, and you can kind of use that at times. I also used to do renewals in the corporate world before too, so I kind of understand that piece too. Yeah.
So Patrick, we're just almost running out of time. But Mansoor, do you have another question for us?
No, thank you very much. Thanks a lot.
Oh, no worries. So why don't you tell us how we can follow you and where to find you, Patrick?
Yeah, you can either, my phone number, anybody can reach out to me. My phone number, it's 647-808-7885. I am the founder of MVP Mortgage Solutions. You can find me on Instagram under MVP Mortgage Solutions all together as one. I do have a Facebook account as well, and also on LinkedIn. Just look up simply Patrick Soy, and you'll be able to find me there. And then all my social media will have my website and all that. But yeah, I'm assuming we'll have this posted and you'll have more of my contact details
I
there.
will add a description and everything on the screen, on your face, so
Yeah.
where you can find you.
Yeah.
Obviously your email as well, and you do make a lot of great mortgage content on your Instagram. And do you have a Facebook page or anything like that?
Yeah. Yeah. It's MVP Mortgage Solutions as well. Yeah.
But it's a pleasure having you today. I learned so much from this 1 hour segment from you. There's so many terms I didn't know, and it's just good to know. I don't think this is the last time we'll be speaking to you, just because there's so many interest rate announcements coming up in July, September, October. So definitely not the last time I'm ever going to talk to you, and I'll probably see you sooner than you may want to.
Awesome. Well, you know what? Thank you for your time. I appreciate being on here as a guest, and I'm sure, I'm hoping most people will listen to this will get to let to know a bit more about mortgages. It is complex, but definitely work with somebody who knows, mortgages in and out and is comfortable sharing that information with you.
And thank you to our live audience for staying today and answering and having so many questions and listening to everything. And this is Johnny Wu from the Real Estate Hotline podcast show. And thank you everyone for coming. And we'll see you next time on the show with more fun guests and more knowledge coming. And we'll see everyone next time. Bye.